expensing, this is WorldCom. When you capitalize something, you make it into an asset, and you depreciate it. When you expense something, you take it directly to the income statement. So the idea is when I capitalize something, let's say I capitalize $100,000, and we're going to make it easy. We're going to have no depreciation that year just because we're going to decide we're going to depreciate it later. Versus if I expense something, I have $100,000 immediately as an expense. If I capitalize, this is an asset that then will get depreciated for the next 4 years at $25,000 a year. For the next 4 years. At the end of 5 years, I've taken a full $100,000 worth of expenses. So it doesn't matter whether I capitalize or expense after 5 years. The problem is in any given year, your net income is going to look different. The initial year when you capitalize something versus expensing it, you're going to have 0 hit to your net income because it's all capitalized. And then you're slowly going to report that income statement versus the expense where you'd have it all in 1 year, and then the following years you'd have nothing, so your net income would look really good. So there are advantages to companies expensing things all in 1 year because the next years are going to look that much better, which is what we were talking about with HP and autonomy. There are a lot of people who felt like that's what they were doing. They were not only writing off HP or autonomy, they were writing off all their bad assets. They were not capitalizing things. They were expensing things that they should have, blaming it all on autonomy. But they took a really big hit this year, and then the next years will look that much better. This is why people capitalize, though, is the idea is I want to slow down the rate it's going to hit my income statement. I'd rather take a little bit of expense every year for 4 or 5 years than to take it all at once. The impact hits to that. Capitalizing versus expensing, this is the difference between a capital lease and an operating lease. When I capitalize a lease, when I have a capital lease, I'm putting it on the books as an asset. I'm also going to have a liability associated with that. That's how I get it on the books. And then I will depreciate it over the life of the asset. So eventually it'll hit my income statement. An operating lease, I just hit every single year. So WorldCom took an operating lease and made it into a capital lease when they should have kept it as an operating lease or operating line expenses. And they did that because they wanted to slow down the rate. The difference is they did not show the liability associated with that. They just capitalized it instead of having, but that's the idea. So that's why we call them capital leases. They're assets. We capitalize needs to make into an asset versus an operating lease, which is an expense item. Yeah.
So WorldCom was the lines that were out there that they didn't own, that they thought that they owned, that they capitalized on that component of it. So is this a physical or tangible asset, or what is that what it has to be?
It's supposed to be, it doesn't necessarily have to be a physical, tangible asset, but it has to be something that has future benefit. And the problem is, if they had made a one-time, if they had to make a one-time fee or pay for it one time to somebody, then you might be able to say, yeah, this is a capital asset because you're going to use those lines for the next 5 or 6 years. Right. The problem was these were routine rental expenses that they had to pay every single year. And so if you're making that type of arrangement, you don't have anything that's of value in the future because you're making the same payment over and over again. So it's kind of a use it or lose it policy. They were making the argument that even though they had all this excess capacity, at some point in time, those rental agreements would be of much more value because you were going to expand the capacity and they'd have more and more clients to be able to use it. It was a weak argument at best. They might have gotten away with it if they'd actually disclosed it rather than trying to hide it. So the fraud was in the fact that they didn't disclose it in the notes. They tried to hide it from the internal auditors. That's where the fraud was. Because AOL did something similar. They took their advertising expenses and capitalized them and tried to do that. But they told everybody in the footnotes. So the analysts there were like, nah, you can't capitalize, these are routine marketing expenses that you're gonna pay year after year after year. There is no benefit other than you have to do them every year or you don't have a client, or you don't have a business. But they at least told people in their footnotes, these are the assumptions we made, this is the life we're amortizing it over, you know, da 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 da. What that does is if it's in the notes, you can unravel it. Same thing with capital versus operating leases. We put them in the notes and we tell you how much are capital leases and how much are operating leases. Why? Because now this is one of the questions from last year, I think it is. I asked them to do a what-if capitalization. You don't have to know how to do that. You can skip that part of that because I told them how to do it last year. We didn't have time this year. You can take the information in those notes and you can figure out using present value what it would be if it's a capital lease, and then you can capitalize it and see what happens to your debt to equity ratio, see what happens to your asset turnover ratio. When you tell people about it, they can figure it out. It's the same thing with the LIFO to FIFO. If I tell people it's what would have been if I'd been under FIFO, they can at least convert it and make all the changes they have to make. If you don't tell anybody about it, they can't make those changes.
Quick question.
Yes.
I actually have to go, but I saw that you went over the ROE driver before
Yeah.
I got here. Is that something that might be in the next?
Yep, it might be, because we hit that right after the midterm. That was, I did two things
Yeah.
right after midterm, which was the direct cash flow and the ROE driver analysis. So those would be the two things.
Will we have to like memorize the formula?
No,
and stuff?
the formulas will all be there. I mean, what I'll do is I'll give you on the list of formulas, I'll give you, and you actually may see it on some of the ones that I have already posted, but I'll give you, net sales to, or net income to net sales. I'll give you basically the profitability, the, asset turnover, and the leverage ratios, but you have to know to put them together as part of the ROE driver analysis. But I won't tell you, this is the formula, you know, how you multiply it through, but other than that, all the component parts will be there. Does that make sense?
Yeah.
Okay,
Thanks.
sounds good. Okay, so that brings us to capitalizing expenses and impairments. Changing life, we did that. Okay, chapters 9, 10, and 11. 11 I'm not gonna do too much on because we just did that yesterday. If your brain is not processed that yet, I'm